In assessing what you can afford to contribute to the cost of your care, a local authority must apply the upper and lower capital limits as set out in the regulations. The upper capital limit is currently set in England at £23,250 and the lower capital limit at £14,250 for the 21-22 tax year. Remember that recent government announcements mean these limits will change in 2023, so you may want to check out my video on that specific topic. So, if you have capital above the upper capital limit, you will be expected to pay for the full cost of your care. If you have capital between the lower and the upper capital limit, you have to make a contribution from your capital. But if you have capital below the lower limit of £14,250, your capital should be disregarded in the local authority assessment. Not all of your capital assets will be taken into account for the financial assessment. I will explain the main rules of what is excluded in this video. However, there is a huge amount of detail and various exemptions and conditions, so I suggest you follow the link in the video description below for the small print. The first category of capital asset that may be disregarded in an assessment is property. These are the specific circumstances where your property will not be taken into account. Firstly, where you are the legal owner but not the beneficial owner of the property. In other words, you have no rights to the proceeds of any sale. Secondly, where you no longer live in the property but your spouse or someone else on a designated list of qualifying people still lives there. This is often the case if one partner goes into a care home and the other remains at home. There is also the 12-week property disregard rule, which is when the local authority must disregard the value of your main or only home for 12 weeks when you first enter a care home as a permanent resident. They can also apply this rule if there's a sudden and unexpected change in your financial circumstances. Finally, there's the 26-week property disregard rule, which applies in a number of rare occasions involving legal proceedings. So for more details, check out the web link in the description below. There are a couple of situations when your local authority has discretion to decide whether to exclude your property, so it's worth understanding what those conditions are. When someone, perhaps a companion, has given up their home to move in with you and care for you, but then you move into a care home, they may be allowed to remain in your home. Or when what's known as a qualifying relative moves into your property after you enter a care home, but it must be their main and only home. Finally, where a qualifying relative is serving a prison sentence and there is a likelihood of them returning to the property. Essentially, the qualifying relative is considered to occupy the property even if they're not physically present. So that's property exemptions covered. The next type of capital asset that may be disregarded is investments and savings. The only time they are disregarded is when an investment bond includes one or more elements of life insurance policies that contain cashing in rights by way of options to total or partial surrender. If that's the case, then the value of those rights must be disregarded as a capital asset in the financial assessment. There are quite a number of occasions where payments are disregarded from the financial assessment. They can be grouped into a few categories, which are compensation payments for personal injury and a variety of diseases where the courts are involved, payments from a variety of charities and trusts, social fund payments, payments to special guardians and some other benefit payments. It's quite a complex area, so you need to check out the small print. The fourth area is business assets. If you're in the process of selling business assets, but the process is taking some time, these assets will be disregarded from the financial assessment for a period of time, to be agreed with your local authority. The fifth and final category to be aware of is where your assets are held abroad. Where you have capital abroad that cannot be wholly transferred to the UK due to the rules of that country, for example, currency restrictions, the local authority will ask for evidence confirming this fact before it excludes the value of those assets. Thanks for checking out my YouTube channel. I'm Justin King. My aim is to help people to live successful lives, and that often involves understanding earning your money. I hope you've enjoyed this video. If you have, please press the like button to help more people like you find my channel, and check out the notes below for some useful links on the things I've discussed in this video, and for links to the other videos on finding and funding care in later life. For now, I'm Justin King, helping you live your best life.